Episode 4, Money Matters, Code that Transformed Finance. Money makes the world go round, and today, code runs our money. In this episode, we decode the high-tech transformations of finance, from the first banking computer systems to algorithmic trading and cryptocurrencies. You'll hear how a software bug nearly sank a Wall Street firm in 30 minutes, how credit cards and ATMs depend on robust code, and why your digital transactions zip around securely thanks to cryptographic magic. Segment 1. Early days, bank ledgers to mainframes. For centuries, finance was paper and pen, ledgers carefully updated by clerks, human computers calculating interest tables or life insurance premiums. This was tedious and error-prone. By the mid-20th century, as banks and stock markets swelled, the need for automation was glaring. Enter IRMA, electronic recording machine. Accounting, developed in the 1950s by Bank of America and Stanford Research Institute. IRMA was one of the first commercial banking computers, designed to read checks by machine and update accounts automatically. To make this possible, they invented MICR, magnetic ink character recognition. Those funny-looking numbers and symbols printed at the bottom of checks in special ink. IRMA could scan checks at unbelievable speeds for its time, something like 600 checks per minute, read account numbers via MICR, and credit-debit accounts accordingly. It was a triumph of code and hardware. By 1959, IRMA systems were in operation, and Bank of America was processing checks vastly faster than any competitor. This laid the foundation for computerized banking we take for granted. Today, that same MICR tech is still used worldwide on checks, a 1950s coding solution alive in the 2020s. Another leap came in the 1960s with the rise of credit cards. The idea of plastic money required a whole network behind it to verify accounts and balances on the fly. Code had to handle authorization in seconds. Even in the 60s, customers didn't want to wait minutes at a store register. The result was early transaction processing systems that, using phone lines, connected merchants to bank databases. It was primitive at first, often just a voice phone call from the store to a bank operator who used a computer. But by the 70s, this became fully automated, with POS point-of-sale terminals dialing in electronically. We also saw the birth of ATMs, automated teller machines, in the late 60s, the first one by Barclays in London, 1967, though that one used special vouchers and a PIN. By the 70s and 80s, ATMs connected over networks to bank mainframes to dispense cash from your account, anywhere, anytime. This was revolutionary. Banking became 24/7 and geographically untethered. But it only worked because of bulletproof code running in the background. Code to check your PIN, verify you have sufficient balance, dispense the correct amount in the correct combination of bills, and then securely log the transaction, both at the ATM and the central system. Did you know? By the mid-1980s, COBOL, an early programming language, was running most of the world's banking systems. Even today, a significant portion of bank back-end code is COBOL, quietly performing millions of transactions daily, largely because it's so reliable. When Y2K, the year 2000 date rollover, approached, a huge concern was that older COBOL programs only stored 2-digit years and might misinterpret 00 as 1900, potentially wreaking havoc on interest calculations, maturities, etc. Banks spent billions painstakingly auditing and fixing code. Thanks to that effort and coders' unsung toil, the Y2K bug was a relative non-event, a triumphant moment where code professionals saved the day by ensuring your ATM still worked on January 1st, 2000. Segment 2. Electronic markets. From ticker tape to high-frequency trade. At the start of the 20th century, financial markets ran on human adrenaline and paper. The New York Stock Exchange had guys in colour-coded jackets shouting orders and scribbling trades, while information flowed via ticker tape machines. Those little printing devices that spewed out stock prices on strips of paper with a delay of minutes from real time. Fast forward to today, trading is dominated by algorithms and executed by computers in millionths of a second. How did we get here? Through continuous code innovation. In the 1970s, the Nasdaq exchange launched as the world's first electronic stock market. No trading floor, just computers matching buy and sell orders. Initially, it was simply posting quotes from dealers, but over time it evolved to fully automated trade execution. Other exchanges followed suit. By the 1980s and 90s, even venerable NYSE started integrating electronic systems. Code took on more decision-making. Program trading emerged, where large trades would be executed by software according to preset strategies. On October 19, 1987, Black Monday, program trading was partly blamed when the Dow plummeted 22% in a day. The sell-off was exacerbated by automated trading programs, all triggering sell orders in a feedback loop. This was an omen of things to come: the need for circuit breakers and code safeguards to temper rapid, machine-driven moves. The most dramatic demonstration of code's dual power in finance came on May 6, 2010, the flash crash. In a matter of minutes, the Dow Jones Index inexplicably plunged about 1,000 points, nearly 10%, only to recover most of it shortly after. Investigations found that high-frequency trading algorithms, coded to react instantly to market conditions, went haywire, amplifying a sudden selling cascade with blinding speed. One trading firm's algorithm, sell futures as market falls, combined with others in a chain reaction. And some algorithms even withdrew from the market, seeing the chaos, causing liquidity to evaporate. This feedback loop of code interacting with code led to trades executed at absurd prices. Some stocks briefly traded for a penny, others for $100,000. Human breakers were virtually absent. The code had taken over. After this scare, new rules were put in place, like trading pauses when an individual stock swings too much too fast, effectively telling the algorithms, take a time out. It's fascinating. A few lines of code gone rogue can wipe out $1 trillion on the stock market in minutes, and then another set of code has to step in to stabilize things. Equally eye-opening was the Knight Capital incident in 2012. Knight Capital, a major trading firm, deployed new code to its live servers. But a mistake in it caused the system to rapidly buy high and sell low on 148 different stocks. In 45 minutes, Knight Capital lost $440 million, essentially bankrupting the firm. That's about $10 million per minute burned by buggy software. Arguably the most expensive software bug in history in terms of money, hemorrhaged per second. The company was rescued, taken over, but it was a wake-up call. The difference between riches and ruin on Wall Street is often a semicolon in the right place. Yet, on the positive side, code has massively improved finance efficiency. Trading spreads, the difference between buy and sell price, are now razor-thin thanks to competition by electronic market makers. Everyday investors can buy stocks with negligible commission on apps, a far cry from when you had to call a broker and pay hefty fees. Complex financial instruments, options and derivatives are priced and risk managed by algorithms that ensure markets are more accurate and liquid than a human brain ever could manage in real time. The global foreign exchange market handles over $6 trillion a day in transactions, and it's practically all electronic, with algorithms continuously quoting prices for currency pairs to everyone from big banks to your airport kiosk. Without code, that volume and speed would be impossible. Segment 3. Banking goes digital. Secure transactions and online money. Banking for consumers transformed with the internet. In the mid-90s, banks introduced online banking, letting customers check balances or transfer funds from home. At first, many were wary, putting account info online. But encryption, as we covered in episode 1, made it secure. That little padlock in your browser during a banking session means the data is scrambled. Thank RSA and SSL, TLS protocols working under the hood. Code carries your money instructions safely through cyberspace to the bank's mainframes. Today, billions of people trust these systems, swiping and tapping away with barely a thought. The coded protocols of finance, from card payment networks, VisaNet, etc., to interbank networks, SWIFT for international transfers, quietly move value every second. The SWIFT network, for instance, uses standardized message codes to handle international wires. Around $5 trillion a day is moved via SWIFT messages, all mediated by code ensuring each message is authenticated and delivered to the right bank. Perhaps the most headline-grabbing development of recent times is cryptocurrency and blockchain. Essentially, code that is money. In 2009, the mysterious Satoshi Nakamoto released Bitcoin, a peer-to-peer digital currency system. Its innovation was the blockchain, a distributed ledger enforced by cryptographic code with no central authority. Suddenly, currency itself became an application of cryptography and consensus algorithms. Thousands of lines of code define the rules. How new coins are minted, mining, how transactions are verified by nodes, and how the ledger is secured against tampering through proof-of-work puzzles. Bitcoin went from a fringe curiosity to, at one point, a trillion-dollar asset class. Then came Ethereum, adding programmable smart contracts, self-executing code agreements that live on the blockchain. By 2021, people were trading art as NFTs, non-fungible tokens, and locking billions in DeFi, decentralized finance platforms, all essentially bits of code autonomously handling value. It's a mind-bender. We've removed not just paper, but even institutions, replacing them with software as the trusted middleman. In code we trust, say the blockchain enthusiasts, reflecting the mantra, code is law in that domain. Of course, with great power comes great vulnerabilities. Coding bugs in smart contracts have led to spectacular hacks. For instance, in 2016, a flaw in a smart contract called the DAO let attackers siphon $50 million worth of Ether. The immutable nature of blockchain meant that the only way to fix it was a controversial hard fork, rewriting history. A bunch of code intended to be unstoppable did something unintended and unstoppable, causing a schism in the community, Ethereum versus Ethereum Classic. Back in traditional finance, algorithms also run risk management. Banks use code to monitor transactions for fraud in real time. Ever get a call or text about a suspicious charge 2 minutes after it happened? That's an AI and rule-based system combing through streams of card swipes, flagging anomalies, like your card used in 2 countries within an hour, or a charge that doesn't fit your spending patterns. These systems are getting smarter, reducing fraud losses significantly, while minimizing false alarms so legitimate spending isn't blocked. It's a constant arms race. Criminals deploy code, malware, skimmers, and banks counter with more sophisticated code. Segment 4. FinTech and the future. AI advisors, quantum risks, and digital everything. FinTech financial technology has boomed in the past decade. PayPal, Stripe, and others built payment empire codes that let even small businesses do global e-commerce easily. Smartphone apps now handle payments at the tap of a screen, or even just by showing your face. Hello Face ID. Underlying it, APIs, application programming interfaces, provided by banks allow third-party apps to initiate payments or fetch account data securely, with your permission. It's a far cry from the days of manually writing checks or balancing passbooks. FinTech startups use code to underwrite loans in minutes, analysing alternative data like your digital footprint, or to let you split payments, trade stocks for free. Robinhood's app is essentially a pretty interface on top of some heavy-duty brokerage code and market APIs. AI is also stepping into a financial advisor role. Robo-advisors like Betterment or Wealthfront run algorithms that allocate your investment portfolio according to your goals and risk tolerance, rebalancing automatically. This democratizes access to sophisticated strategies once only available to wealthy clients with human advisors. And in trading, AI algorithms scour news and social media for sentiment signals. One famously noticed unusual Wikipedia edits on corporate pages as a predictor of pending stock moves. Probably more correlation than causation, but still, it traded on that insight. High-frequency trading firms even place their servers as physically close as possible to exchange servers in the same data centers, because a few microseconds advantage in code execution can be worth millions. They've effectively bent physics to their will, laying straight microwave towers to shave milliseconds off New York-Chicago transmissions. Looking ahead, quantum computers threaten the cryptographic underpinnings of much of finance. RSA ECC, meaning an advanced quantum could, in theory, crack account security or blockchain keys. The financial industry is investing in post-quantum encryption methods to preempt that. updating the code of security before the threat materializes. Another frontier is central bank digital currencies, CBDCs, essentially national currencies implemented as digital tokens. If those roll out, imagine central bank monetary policy partially executed in code, like interest-bearing digital money that could encourage spending by losing value if hoarded. And in a full circle, recall how an early programmer like Ada Lovelace envisioned algorithms in the 1840s. Now, in 2025, we have decentralized autonomous organizations, DAOs, where governance and treasury are managed by smart contract code. It's both exciting and sobering. Code can empower, but a single flaw can cause financial ruin in seconds. Perhaps the new financial maxim is, in code, we trust, but verify and test. Money may make the world go round, but code now makes the money go round the world. From the punch card computers sorting checks to the algorithmic traders in nanoseconds, from your friendly banking app to the cryptographic coins of cyberspace, code has indelibly transformed finance. It has made transactions faster, markets more accessible, and spawned entirely new forms of currency. Yet, as we've seen, a stray bug or a clever hack can crash markets or empty wallets at mind-bending speed. The guardians of finance are as much the programmers and cybersecurity experts as the regulators and bankers. So the next time you tap your phone at a checkout or watch stocks jump on an earnings report, remember the invisible digital dance making it possible. It's the code that counts the money, moves the money, and sometimes even is the money. Coming up in our series, Artificial Minds, Code that Thinks and Learns. Can machines really think? We'll explore the wild world of AI, from early computer brains to today's learning algorithms that sometimes surprise even their creators. Stay tuned.